this afternoon, we saw the South African Reserve Bank's response to COVID-19, a deadly virus that has markets panicking. The bank cut interest rates by 100 basis points, but is it enough? And joining me is Mamello Matikinca-Ngwenya, a chief economist at FNB, Fani Titi, CEO of Investec, Peter Attard Montalto, head of capital markets research at Intellidex, and Keillen Ndlovu, head of listed property funds at Stanlib. Mamello, as the economist, allow me to begin with you because I do understand that the consensus was for a 50 basis point cut. He did more than that, but the question is it enough?
That is the big question. As you see, we had certainly expected 50 like the market. But I think if I look at their growth projections, so they see in growth, at negative 0.2% this year. And when I compare that to what we are expecting and some of the relatively bearish forecasts that are out there, it seems as if there is definitely scope for them to cut interest rates a little bit more. And then the governor also pointed out today that when asked if they're going to use other monetary policy tools, it seems as if the interest rate or the repo rate is a tool that they are likely to use going forward. With that said, I think that if they do decide to cut interest rates as the situation evolves, they'll probably be marginal in terms of how they respond. So I don't think we're going to see another interest rate cut of this magnitude.
Right, and Peter, you were dialed into the briefing there that was given by the Reserve Bank governor. You asked a very interesting question around whether the bank had looked at potentially lowering the reserve rate requirement for banks, potentially, I imagine, to be able to use their money to lend more. Were you satisfied with the response that you got?
Well, this was a really challenging MPC meeting, and whilst 100 basis points is going to provide some support into the economy, it's really going to be very, very marginal here. I think the central bank's forecasts basically are not relevant here. I think as a central bank, they're always too conservative in how they step down forecasts. We're now at minus 2.3% for this year for South Africa, and a risk of a much longer tail from that. And I think the problem here is, and I think why the MPC today was so challenging in communication terms, was this is not a normal cyclical shock. This sounded like, from the statement, a big but normal cyclical shock. This is really very much a sudden stop break in the economy. The economy's been closed down to tourists effectively for the foreseeable future. And I think that's why price rate, if you like, is not important. It's ultimately about quantity of money. That's where the reserve rate requirement comes in and these other factors. And I think where looking backwards, this is okay. I think the issue is this is doubling. The virus now doubles cases on shore every 2.5 days. When we look back in 2 weeks' time, I think this will look very much inadequate and far too conservative.
And Fani, just to bring you in here, you have been here before. I mean, 2008, you saw the kind of volatility that we are seeing across global financial markets right now. You saw the kind of stimulus injections being announced by global central bankers all over. What do you make of this volatility that we're experiencing today and how it compares to 2008, and whether the decision by the Reserve Bank and what has been announced by government so far is sufficient to help us weather the storm this time around?
Yeah, I think the current reaction to the coronavirus is, in my view, unprecedented. It is far more significant and deeper in impact than the global financial crisis of 2008. In 2008, we had a financial crisis. Today, we have a public health crisis that affects confidence and, in fact, source panic in individual homes and in communities. So the sudden impact of it, in that it shuts down communities, you shut down schools, and really you have a situation where demand stops. There's a panic as to what the impact on communities will be, what the death rate could be. While we do believe that the death rate may well be low, individual people are scared, people are staying at home, they are not going out to restaurants, they are not going, some of them, to work. So the impact is psychological, it is economic, and it is financial. We've seen over the last 3 weeks, stock markets are just downwards in excess of 20, in some cases 25%. And this is a level of dislocation that requires significant action. So the rate cut at 100 basis points is welcome, but I would think it is going to be woefully short. In most countries, you've seen governments come with huge stimulus packages. You've seen a level of quantitative purchases by central banks and an infusion of significant liquidity, and yet stock markets continue to move down. So this is far more serious, in my view, than the crisis that we saw in 2008.
And of course, I mean, a country you'd be interested in, the UK, just announcing, I believe, that interest rates have been cut once again now to 0.1% to try and quell the effects of COVID-19. But we'll get there. Keillen, to bring you in right now and just to help us understand the consumer perspective of what was announced by the Reserve Bank today, 1% cheaper in my bond repayments and in my loan repayments. It has been a buyer's market in South Africa for the longest of time. What are you expecting this cut in rates to do to the property market? I mean, which has essentially been in the doldrums for the longest of time as well.
Yeah, sure. It's a relief for the sector, more so for the interest bill for the property companies. But you find that property companies, their balance sheets are getting stretched with almost 40% loan-to-value ratios. About 80% of the debt is fixed. So 20% is floating. That will benefit from the rate cut. That's from a company's perspective. From a consumer, yes, it does help as well to reduce your interest bill, your mortgage, credit card, so we can shop a little bit more. But the challenge is, as Fani mentioned earlier on, is that people are not going to the malls due to the coronavirus. And then there was a law passed yesterday that after 6 p.m., most of the restaurants, pubs, clubs, taverns, they can't trade after 6. So we can have more income, but there's probably less to spend in the malls. So that's our biggest concern, that the restrictions will affect trading in malls as well as turnover, and that could impact the tenants in terms of the ability to pay rent.
I'm glad that's a big concern for you, Keillen. It's a huge concern for me. I mean, no more GNT sundowners, like no more wine when you have your supper late at night. But jokes aside, because this is a very a critical moment that we are in as South Africa's economy. And Mamello, just to bring it to you, and if we just shift the focus onto solutions now, you know, what stakeholders, government specifically, but also the private sector can be doing to help South Africa weather this COVID storm. What, in your view, can we do? What are the low-hanging fruits here that we can exploit?
So I think, just taking it back to the point that Peter raised earlier around that, you know, the infection rates are probably much higher than what is being announced in the media right now. I think what is quite critical is just to make sure that in terms of, you know, the healthcare services, that there's enough capacity and enough resources allocated to ensure that, you know, once the numbers start to increase, you know, we tried to accommodate as much, you know, as many patients as possible. And I also think just maybe reprioritization of funding, that perhaps we need to look away from non-core state-owned entities. And maybe this is an opportunity for government actually to maybe start thinking about structurally shifting how they spend and which things they choose to fund. And with that said, I think it's obviously going to be quite difficult, but I think the time to act is now, and perhaps that they can use this opportunity, or this crisis rather, as an opportunity to later on be able to consolidate the fiscus.
Mm-hmm. And Peter, your views on what we can do?
I think this is going to evolve very, very quickly, particularly as you see more onshore transmission starting to occur. I think the run down lower in bank stocks this week has been very concerning. Indeed, we've seen liquidity drying up now in the government bond market. And as a result, I think the SARB will be back. I think they will probably be back next month with emergency measures intra-meeting particularly on liquidity. Particularly, I think we'll see them standing up, talking about notional support for bank deposits as well. And I think this is the problem. This is going to move very, very fast now onshore. This is what we saw in Italy. It's what we saw in France as well. And I think the real thing that the SARB is going to have to step up and do is provide support to banks to provide forbearance on loans. The Treasury is so restrained here, they can't really have any space, I think, to do anything more meaningful. It's really going to come down to banks providing forbearance into the economy. And the way the Treasury and SARB can support banks doing that is how you're going to have the largest, I think, stimulus effect for an economy that's very constrained.
For sure, Fani, and of course the Reserve Bank did announce that they had assessed the financial situation here in South Africa and weren't seeing any signs of strain just yet. But you said that the decision to cut interest rates by 100 basis points welcomed, but significant more action needed to be done. Can you tell us exactly what you believe that significant action is?
Look, the economy was already quite weak going into this particular crisis. And as we know, the Treasury has very limited fiscal space to put stimulus into the economy. So what is left for us is really some room on the monetary side. The cut in interest rate is obviously useful. The banks in this country are well capitalized. They are well run. And obviously, they will be able to support their clients up to a point, given that we don't have a sense of how long this particular crisis may last. I think it was Peter who said correctly that the worst is still to come with respect to the effects of the crisis. So the banks will stay close to their clients. They will try to help them, but there are rules and regulations in place around the levels of capital that banks have to have. And maybe at a point, as happened in the UK and in Europe specifically, there could be some relaxation of some of the capital requirements that would allow banks to do a little more than they can do at the moment. Again, it would be just a matter of helping the banks to do more, not because the banks are under any stress at the moment. Our banks are well run, they're well funded, and they're well capitalized.
And then, Fani, is there room for the banks to help the consumer a little more in this environment? In Kenya, we did see the government asking consumers there to avoid using cash to contain the spread. But by migrating to digital platforms, he did ask the banks there to lower transaction costs. Any room from the likes of Investec or South African banks to do the same here?
Look, we obviously do not have any branches as Investec, so we've always been digital. And I think most of the banks in the country have a level of digital platforms, and consumers can interact with banks that way. A large number of the population still depend on cash transactions, so they still go into bank branches or they do redeem cash receipts at supermarkets. So there will still be a level of dependence on that type of infrastructure and the risks that are associated with going into physical branches like that. I think banks can do a lot to support their clients. As I say, our country's financial system is particularly sophisticated. But at the end of the day, to reach that demand, you require a level of support that is beyond what we have at the moment.
All right. And Keillen, final words from you. 80% of the property sector's debt is fixed, so this interest rate cut is only going to have an impact on 20% of that portfolio. I mean, are you saying continue selling property stocks?
Well, I guess if you look at the property stocks now, we say the interest rate cut, the impact is probably minimal, even in terms of driving South African GDP growth. So the focus of 0.2% GDP growth, not so positive, but if you look at the valuations in terms of property companies, the property companies are trading at yields of over 18%, and they're now trading at discounts net asset values of over 60%. So implying that the market is priced in most of the bad news. Yes, we're in a volatile market, but the valuations are reflecting that. with the share prices falling over 50% year to date.
So the next conversation you and I are going to have is around which property companies are worth picking at those discounts. But we are out of time for now. Thanks so much to everyone who joined us on the line for this conversation. Mamello Matikinca-Ngwenya, who is the Chief Economist at FNB, Fani Titi, CEO of Investec, Peter Attard Montalto, Head of Capital Markets Research at Intellidex, and Keillen Ndlovu, Head of Listed Property Funds at Stanlib.